A very good evening to all the members who have registered for this particular session. Myself, CA Rekha Umashar, Regional Council Member, SIRC. I take immense pleasure in inviting you all for the session on transfer pricing. So today we have two eminent speakers to discuss about the topic of transfer pricing. So to tell about this particular topic, this is one of the topics that is creating quite a buzz these days, especially with the increasing number of mergers and acquisitions, especially when how you need to price a particular transaction, say how, especially with respect to product or services internally within a business, especially when the business has a common ownership, say more component subsidiaries, holding and associates, how the accounting can be done, how the computation of profit can be done, how fairly it can be reported. So all this is included, especially it has a special significance when it deals with avoidance of double taxation. So again, you check into the transfer pricing rules. So to discuss about these, today we have two eminent faculties, especially why I'm telling this is they are completely from the area of transfer pricing. So the first speaker for the day is Tejas Dharwadkar sir, and the second person for the day is Meenal Sabnis ma'am. So to tell about sir, sir is a chartered accountant having more than 16 plus years of experience across industries, especially consulting experience in the field of international taxation as well as transfer pricing. His major areas or his industry of specialization comes under manufacturing companies, engineering companies, service companies, automotive sector. Sir is also the partner at the Uniquest Risk Advisors LLP, which is based out of Pune. He has advised several large Indian as well as multinational corporate groups on various aspects, especially relating to domestic and cross-border taxation, consultancy as well as litigation. And to say about his clientele, he has worked with various large clients, especially Volkswagen, Skoda, Emerson, Tata Motors, and also HP Fuller and KPIT. So he also has assisted many companies, especially in setting up their branches or operations in Europe, Southeast Asia, and Brazil. And this also includes his global transfer prices and litigation support. I take this opportunity to welcome you, sir, for this particular session. Then we have the faculty for the day. We have another eminent faculty, Meenal Sabnis ma'am. Ma'am is also a chartered accountant, close to a decade of experience and consulting experience, especially in the areas of tax and transfer pricing. She is also working as a senior manager at the Uniquest Risk Advisors LLP, which is based out of Pune. And her major areas, our industry specialization includes manufacturing companies, automotive, engineering companies, and service companies. She has also worked with multiple medium-sized firms as well as multinational firms, and over the entire period of her career, she has advised on various aspects such as taxation, compliances, litigation, and consultancy. So I take this opportunity to welcome you, ma'am, to the session. The session is all yours.
So hello friends, good evening to all of you. Rekha, thanks for the kind introduction. Also, you set the perspective very nicely, about transfer pricing. So I think with that background, let me just dive into the subject. I hope in the next couple of hours, I will be able to add more value to the audience as we go along. Thanks, Rekha. Just from a technology perspective, what I will do is I'm assuming I'm audible. I'll not keep on asking I'm audible. I'm assuming that I'm going to be audible, and if there is any drop in network or something, I'll request the organizers to just ping me on my phone and I'll come back. I think that will be easier so that we have continuity in the discussion. And another point, we will take a question answer session towards the end of the session. In case you have, please request if you can put it in the chat box, and then towards the end, I will surely make sure that I can answer as many questions as possible along with my colleague Meenal. Yeah, with this background, I'll just share the screen and I'll start the session. Yeah. So the word, just let me just minimize this window. Yeah. So, we are here to discuss transfer pricing. I think Rekha has already given a perspective on transfer pricing. this word transfer pricing or this section has completed around 21 years in India, because they were introduced in 2001. And when we had decided to speak, the topic is the journey so far. So, it's become 21 years, as such, if it was a person, it would have reached its adulthood today. And what I will do is, during the course of today's discussion, I will discuss the journey about how it was born to the adulthood and what it has gone through. And during this discussion, we will, what my endeavor is, that we will touch base on various topics which are important, that are the various issues, key landmark judgments, and way forward with respect to the transfer pricing provisions. Interestingly, the word transfer pricing is not discussed, or it is not defined anywhere in any of the provisions. It is used in layman common parlance. The word is used, it has got its origination again in our memorandum of 2001, and then it continues globally as that. That's the way it is. And the word FAR in transfer pricing parlance has a specific relevance, and that is the whole reason why we have got this name, the journey so far. So let's dive into it. As I said, that this is what we plan to cover: how TPS progress in India, the broad process flow of transfer pricing. Here I will quickly spend a couple of minutes for all my friends who don't know about transfer pricing and what the broader process involves. With that, maybe I'm moving ahead with respect to the issues, and the issues are broken down primarily into the aspects of functional analysis, economic analysis, and then we'll be discussing transactional issues towards the later part of the submission. And of course, we'll end the submission. We'll end this presentation with emerging issues. That is, what are the emerging issues in transfer pricing? For the sake of in transfer price, there are a lot of abbreviations, and we like to use a lot of acronyms. So all of these acronyms are here already in your face. I will repeat. I will be using most of them during the presentation. My request is that this presentation would be shared with you whenever you want to refer anything in the slides subsequently. You can come back to this. With this, I'll dive into the topic. And this is I've tried to recreate the economic times. Of course, I'm not sure whether economic times was existing, but I've tried to create the economic times which would have been on 1st of March 2001. And the way it would have looked is transfer pricing rules introduced in Finance Bill of 2001. And what would be the key headlines? Because transfer pricing has become one of the key topics, as Rekha mentioned, and all the multinational companies, whether inbound or outbound, all are mesmerized by this word. In fact, a lot of whenever there are research done, the top 5 issues which any multinational faces, transfer pricing always appears as one of the top 5 measures consistently over the last decade. And with this, the key purpose, when this the headlines, if you look at it, there are 2 things which always stand out: measures to curb manipulation of prices, and India now gets a fair share of global prices. So this is the baby which was born somewhere in 2001. February 28th, the budget was done, and this is the way it would have looked. But what happened, and then the journey of this baby is what I'll just try to take you through today. Of course, the baby, before the baby is born, the parents would have conceptualized. In this case, let's say the government, they would have thought through what is transfer pricing and the need. And transfer pricing is not something which is unique to India. This is something which is globally a well-settled law, and the reference to transfer pricing dates back somewhere way back in 1915, where UK had certain laws on transfer pricing. Of course, their specific laws came somewhere in the year somewhere in the 90s decade. But overall, if you look at it, 6 countries had transfer pricing law as a formal law before 90s. Subsequently, 17 countries in the 90s, and then 2001 onwards, if you look at it, 14 countries, and then the list goes on and on. So this is where the Indian government conceptualized that we should have something on transfer pricing. Whether we had something already in our law before 2001, the answer is broadly yes, because we had these 4 sections which broadly talked about transfer pricing, which is by way of business connection and attribution of profits to business connection. 48(2)(b), which is related party, but always it was with the concept that we will cover the domestic entities there. The next was section 92. It was there in existence, but it talked about close connection between residents and non-residents. And then there was section 93, which was in place. So this was the vague transfer pricing law, or let's not even call it transfer pricing law. There were certain provisions which we can call it as transfer pricing at that point of time. Now, what were the issues with these regulations, and why did the government decide to have this baby of transfer pricing at that time? One, of course, the law was not in line with the global law, and the nomenclature or the law which was there in some of the established or developing countries or developed countries was very different from what it was in India. The term close connection, etc., are not used rampantly across jurisdictions. It is very specific to India, and therefore, we needed to have some nomenclature which are globally used everywhere. What documentation to maintain? Who has to maintain the transfer pricing documentation? No clarity on that. What is covered? What is not covered? What transactions? Which transactions are covered? So these were the certain issues which were there in the earlier law, and therefore, the 90s decade, of course, always, with this globalization and India opening up its economy, lot of inflow of foreign exchange that started. Of course, at that time, the government would have thought that we need to have a law on transfer pricing at that point of time. And that's the way the law was introduced in Finance Act of 2001. So a snapshot of the budget memorandum I have just pasted here. This is just pasted from the memorandum. And if you look at it, interestingly, the words, the way, towards the second half of the slide, if you look at it, the profits derived by such enterprises carrying out business in India can be controlled by this multinational group by manipulating the prices charged. So the words which they wanted to introduce was they wanted to avoid manipulation of prices charged paid for these intra-group transactions. Also, the next paragraph talks about fair and equitable and reasonable profits that should be attributable to India. So these were certain words which are very important, and as we go along, we need to keep them in mind. The reason why transfer pricing law was enacted in India. So to avoid any kind of manipulation of prices, and the word is manipulation. It is not any kind of, so tax avoidance could be used as a parallel in that sense. And therefore, Chapter 10 provisions came into existence in the Finance Act of 2001. I have just summarized the provisions here. This is a snapshot of the TP regulation. So the baby came into world with these things. The introduce, on the right hand side of this slide, you will see the years. I have already mentioned about the years where which provision came into enactment in which year. For me, I've been, me and my colleague Meenal have been doing transfer pricing for a lot of years, and I always tell very simple way of looking at transfer pricing. Of course, the charging section is section 92, but then there is A, B, C, D, E, which I always talk. A is associated enterprise, B is business international transaction, C is computation section, so computation of arm's length price. D is documentation, that is what all documentation is to be maintained. E is e-filing, so we need to file the form 3CB e-filing, so that is what it is. And F is of course definition. That's a very simple way of remembering the provisions of transfer pricing. These are the rules which are there. I'm not going through some of these in detail because naturally as we progress, we will go through some of these at various points as we refer them. Yeah, this is a very interesting slide. What I've done in this slide is that what are the key amendments in the Indian transfer pricing regulations right from its inception to 2021 have been captured here. Of course, these are the key amendments and not every amendment. And why I'm bringing this slide on is that, as I said, that baby was born in 2001, but as it grew, the baby needs, it keeps on understanding, it needs certain more knowledge, you need to teach more things to it, and that has kept on happening. And the best practices globally, because of the issues it was facing, we have to keep on modifying, keep on teaching the baby new stuff. So in 2009, somewhere, they realized that as the litigation started expanding at that time, they came up with this DRP. The DRP was constituted in 2009 by the Finance Act of 2009. Subsequently, the safe harbor rules were also introduced, or it was not introduced actually, but the provisions were enabled in the safe harbor rule of the Finance Act of 2009. Also, they realized that we cannot be very perfect with the computation of arm's length price. So they made sure that there is some kind of bandwidth which is given. This plus or minus 5% adjustment also came in 2009. Roughly 9 years into the existence, it was at that time. 2012 is a very notorious year. This is the year where a lot of these retrospective amendments, etc., came into picture. But let's leave the overall controversy aside. 2012 is the teen year, where it was becoming 12, 13. It was on the border of become. So the teen tantrum started becoming very evident. And then, you know, if you look at it, there was the maximum number of amendments happened in 2012, where, you know, a team has to be taught a lot of things. You have to continuously be in dialogue with that. So this APA mechanism was introduced, e-filing of Form 3CB, SDT was introduced. Other method was specifically given some guidance on that. The tolerance limit, as a team, you know, your tolerance limits goes down, so that 5% was brought down to 3% or 1% at that time. All this thing happened in 2012. So I always relate this with the teen tantrums, because, you know, by that time we were nearly in the teens. 2015, you know, we went progress certain 3 years. They realized that, you know, we need not be so strict with the law, and therefore, you know, the SGT limit was extended from 5 crores to 20 crores. You know, and then, you know, the range concept was introduced in 2015, not by way of a finance act, but it was by way of a notification. But that was something, again, you know, helped the overall transfer pricing world significantly. So this teen tantrums, you realize that you cannot be very strict with them. You need to be a little bit more loving and caring with them. And in 2015, some of these provisions were a little bit diluted a bit. I will say in 2016, it got another frame by way of BEPS, where it realized that, you know, we need to have BEPS, which is also our partner having similar kind of expectations. I'll cover that a little subsequently. But BEPS was something which was introduced globally in 15, and 16 we introduced the provisions in our law year. And then 2017 onwards, you know, more or less certain additional provisions again based coming out of BEPS and the recommendation, which is secondary adjustment, thin capitalization. And then, you know, again they realized that SDT for 48 transactions is not something which was necessary. So this slide covers the journey of transfer pricing and the key amendments which have happened in the transfer pricing regulations over the years. And I always, whenever, you know, I look at it, it is like a journey of a baby to becoming a 21 years, which is now reaching adulthood. And let's live that journey. This is a slide which has a number of amendments every year. Nothing major coming out of this. I think what is important is what lies ahead. With this background, what I will do is now I will jump into the transfer pricing process. What we are going to do as part of this presentation is that we are going to cover each and every aspect of transfer pricing. What are the issues, key issues, and I'll say that what are the key issues which every aspect which we have there on the screen are is important, and then we'll speak about it. So, you know, abroad, for somebody who is new to transfer pricing, you know, I'll introduce you to the concept of transfer pricing. Of course, the underlying principle which I mentioned in the first slide is to avoid manipulation of taxes. That's the way the memorandum read. But what the purpose is from a transfer pricing perspective is that whenever you're dealing with your group company or with your group entity, you want to make sure that the transactions reflect an arm's length behavior. That is what the third party would have behaved with each other. What is arm's length? Well, I think all of us have been through school, and in PT we used to stand at arm's length. That is what they used to say. That is distance, a safe distance, which is maintained from the next person so that it reflects some kind of gap, and then you are at safe distance. That is the word how the arm's length has come into picture. So in a transfer pricing analysis, you know, broadly there are three compartments which are important. First, the one labeled on the left hand of the screen with inputs is something where you collect the information with respect to the international transactions. So whether it is a functional analysis, the group overview, or industry overview. So this is where you collect the information about the international transaction, and also you collect the information about the parties to the international transaction. Once you collect the information, you have to process it. So you need to find out certain comparables. That is the economic analysis. That is where, you know, all these jargons come into picture about characterization, tested party, most appropriate method, and we will go through it one by one. But this is something, the box which is the center of the slide is economic analysis. And the output of the economic analysis which is there is the determination of arm's length price. So this is the overall process which is there in transfer pricing, if you ask me. And, you know, I will try to keep it very simple, and I always like to give some real life examples when I discuss transfer pricing. It is of course about business, but what also I can always relate to is that some one-on-one examples which we live through. So, you know, this process of transfer pricing is very akin to matchmaking process of bride and groom. where you always have, you collect the information. There is a bride, there is a groom. You understand about the bride, what he wants, what she wants from the marriage, what is her expectation. Then you also understand about the parents. You understand about their background. So all these things comes on the input side. Then the economic analysis, where you find the correct match. So out of those match, if you go to these matrimonial sites, you will have a lot of these profiles which are there. Then you find out the perfect match by putting on some of these expectations, and then you shortlist certain profiles, and then you go ahead. So this process of transfer pricing is very akin to matchmaking, and as we go along, I will also elaborate on that, how it goes along. For today's discussion, we have got 5 baskets where we will be discussing the transfer pricing disputes. What we are doing is, for each of these baskets, we are going to discuss the main issue which arises from this basket. What is the approach, that is what we feel are the key points for consideration. And here I will also give my opinion. Mind you, this is going to be my specific opinion, and it should be not be treated as the firm view, but I will try to give what is my opinion along with certain backup rulings for each and every issue. With that, I'm just diving into the first issue, and it all starts with identifying associated enterprises. I think the whole gamut of transfer pricing revolves around associated enterprise. So the term AE, as we have defined, is associated enterprise, and the law has 2 sections which define what is associated enterprise. So section 92A, as I mentioned, has got a definition of associated enterprise. There is 92A1 and 92A2, and the classic dispute on the AE lies that whether we need to look at these 2 sections holistically or we need to look at it independently. So on one hand, when you go towards the center of the slide, the question is whether subsection 1 and subsection 2 of section 92A are independent of each other. So what does section 92A1 mean? It says that means direct or indirect control. So where 2 parties, so one party is controlling the other either directly or indirectly by way of management, control, or capital. That's the way the broad section speaks about itself. I'll not get into the wordings of the section, but if the law had stopped here, there would have been no clarity, because there is no definition of management, control, or capital, and we would have had to run helter-skelter or towards other laws to find out, or other sections, let's say, to find out the meaning of this. So 92A1 by itself was not very, it's not a very robust section. It gives a broader definition of where the relationship gets established. But when you move to section 92A2, they have defined certain specific criteria, which is if you have got participation in capital, which is more than 26%, loan of more than 51, and there are these conditions which are mentioned there. Now the question which arises in transfer pricing is that whether I need to look at only these conditions on the right of the screen, which is section 92A2, or I need to look at both together. So giving you an example, what I want to say is that if I'm not fitting into any of the criteria mentioned in section 92A2, can I still, because of control or management or capital, fall or be an associated enterprise from a transfer pricing perspective? Because I think 92A2 is very easy to read, and if you look at it, there are numerical numbers mentioned for most of them. You read it and then you apply it, and then you will become an associated enterprise or you will not become. But the moment I go to section 92A1, everything is a bit unclear there, and therefore this controversy arises with respect to AE. There are rulings in case of Diageo where it has said that it should be looked at in together, that is section 92A1 and A2 should be looked at together, and if you don't fit into any of the criteria of A2, you will still, and if you are able to establish, or the tax authorities are able to establish, let's say the management or control or capital in some way or the other, you will still become E. To keep things simple, I've also mentioned the case laws which mention the other way around the rulings. Nonetheless, from our side, I think what we need to follow, or what we follow, is that as per ICAI guidance, what they have said is that only the deemed AE concept, which is section 92A2, is important, because management, control, capital is not something which is defined, and it becomes a very loose term. So 92A2 is what is more important, and the Institute TP guidance note also recommends that you use these conditions to identify the concept of AE. So the relationship between AE, you look at 92A2. With that, I think we move ahead to the next concept, which is international transaction, section 92B, which is business international transaction. A transaction between two or more associated enterprises, either or both of whom are non-residents. That becomes, this is the concept. So in this slide, what we have done is we have broken this into two. One is international transaction and deemed international transaction. There is also a concept of HDD, but we are not covering that here because there is a separate section on that. And it covers separate transactions with respect to domestic transaction. Once the AE relationship is established, the next biggest task is to identify the transactions between the two AEs. So mind you, again, I'll come back to this transaction between two or more AEs. I think the basket is something which will travel during the presentation. Either or both of whom are non-residents. So two residents is something which will be not allowed from a transfer pricing perspective if you read the law simply. And then there is something known as 92B2, which is where it's a deeming international transaction. So this is deemed international transaction where a lot of multinationals used to impose certain third party in between. If that third party was acting as a in between to break the chain of transfer pricing, from that perspective, I think deemed international transaction was introduced into the law. What are the issues when it comes to international transaction? So the first issue is whether disclosure in financials, that is agreements, etc., is necessary for determination of international transaction, or the conduct of the parties could result in international transaction. So this is a very classical issue in transfer pricing. Normally, when you start identifying international transaction, you will identify from the transactions from your related party transaction. But is there a possibility that you can also identify international transactions which are not in your related party transaction? And some of the examples which are classic cases is AMP, or known as marketing intangible issue, outstanding receivable, which may or may not arise from your related party transaction. Example, guarantee, for if you're not into Ind AS or something, the guarantee provided by one entity to another may not be disclosed in the RPT transaction. Now, the answer or the key point from our side which we wanted to mention is that disclosure in financial agreement, etc., is persuasive step in identification of transaction, and the moment there is a disclosure, more likely than not there is going to be international transaction. But the moment the conduct of the parties is also important, and if the reason for this is that section 92 F5 defines transaction is also a transaction which is in concert, that is between two parties, they are acting in concert, whether the same is in writing or whether it is meant to be legally pressed or not. So anything which is even a concert, that is not in writing, but both the parties are acting in such a manner that it is resulting in a transaction, in our view needs a deeper investigation, and that is where the FAR analysis comes into perspective. Unfortunately, or let's call it this way, that the two rulings available in this regard, we have a Maruti Suzuki ruling of Delhi High Court which says that, and it is in the case of AMT, where it says that underlying agreement is more important for determination of international transaction. Vis-a-vis that, in the case of LG Electronics, it was held the other way around, underlying agreement not needed for determination of international transaction. The next question or the next issue is that whether transaction between two resident A's would qualify to be an international transaction. I already answered that transaction between two resident A's may not qualify as an international transaction. This leaves a little bit of lacuna in the law, and lot of I'll not say a lot of companies, but it leaves a scope for a lot of multinationals to plan the transaction. It has not yet been plugged in. I think there have been case laws which also mention in case of Renault and Asterix Laboratories, where it says that transaction between two resident A's does not qualify as an international transaction. Then the third issue is whether transaction with resident third party would qualify as deemed international transaction. So this was a classic dispute which was there prior to the Finance Act of 2014, but that has been already, the loop has been already plugged in, because in the finance bill of 2014, even a third party, whether resident or non-resident, whichever has been imposed between two associated enterprises to avoid transfer pricing, becomes deemed international transaction. So the rulings which we have mentioned, some of them pertain to the period before 2014, that is no Nordics, etc., mentioned that the deemed international transaction cannot be with a third party in India. But if you are in today's situation, post finance bill of 2014, deemed international transaction with third party is something which you will have to report in your form 3CB as well as your transfer pricing study. With that, I think we come to the most important concept, and the header of our presentation is that the journey so far, and the FAR stands for functions, assets, and risk. I'll again mention it, that the functions, assets, and risk. And what is the FAR analysis? I think we have mentioned it in the slide. Gathering information about the controlled transactions, that is one thing, and participating entities to understand the economically significant factors affecting the transaction so as to facilitate appropriate assessment for purpose of comparability. There are these three baskets where we have identified what does functions mean, asset mean, risk mean. But towards the end of that, the column, what does function mean is something which are highlighted in a little bit of bold and with bold font. With respect to functions, the key question which we have to ask is who does what. So when you're looking at functions, you have to understand who does what. So who between the two participating entities is doing marketing, who is doing manufacturing, who is doing R&D, sales. So the function part of it covers who does what. In assets, the question moves from who does what to who owns or employs what. And there's a bit of a difference between owns and employs. Nonetheless, for our discussion, who owns the IP, who employs the IP, who owns the patent, who owns the facilities, infrastructure. That is something which is important from an asset perspective. And when you come to risks, the question is who bears what. And when we say bears, what risk they are bearing. That is, what are the consequences of the transaction that they are bearing. Market risk, service risk, industry risk, so inventory risk, R&D risk. The culmination of all three together is something which is a jargon used in transfer pricing world known as characterization. And what is characterization? Characterization of the participating entities is something which is the output of the FAR analysis. What does characterization mean? It goes with the economics principle that more the risk, more the return. So an entity which is characterized as higher is in the risk of value chain, normally higher should be the return. But over the years, as we have been looking at the case law and the way profitability analysis we have been doing, the way I look at things is a bit differently. I say is that more the risk, the more uncertain or fluctuating the return. Because it is not necessary that more risk you will have higher returns. If that was the case, everybody would have taken higher risk and come up with higher return. But what happens is the more risk you take, the more chances of you making higher profits or even losses in certain situations. With that, I think this is the concept of FAR analysis which is there. We have got input on the input side for any kind of function analysis. As I mentioned earlier, it's a matchmaking process where you will have input. On the input side, you will have entities, transactions involved, terms of business, business processes, financial result, etc. And on the output side, we have got risks, opportunities, etc., etc. More on FAR as we go ahead, because the entire transfer pricing analysis is about FAR analysis. What I've done is, for the sake of ease of understanding, there is a sample FAR of a manufacturer. And typically there could be 4 types of manufacturers. There is going to be a full-fledged manufacturer, license, contract, and tool. These are the common, let's say, characterizations that are normally used in TP jargon or the TP world. Full-fledged is something, example, who owns the brand, who owns the IP. Let's say the Maruti Suzuki of the world or Tata Motors of the world would be a better example. They would be the full-fledged manufacturers. The licensed manufacturers, they are a little bit stepped down. They also bear the market risk, all the risks. But what happens is they don't own the IP. They get it as a license. So examples of the world is all the incoming auto companies like Volkswagen, Skoda, who are working more like a licensed manufacturer, where they get the license to manufacture the car. The IP is owned by somebody else. So the Polo, the Vento, or any of these new vehicles which they have launched, they are owned by the foreign companies, but the license is given to manufacture them in India. The third type is a contract manufacturer, where there is a contract given, you manufacture these number of products. The material requirement is on the manufacturer. And the fourth is the toller. And why this is important is that the risk profile keep on reducing. A full-fledged manufacturer like Tata Motors will have the highest risk. They will make more profits when they are doing their gungo about their business, and they will make losses when they are in shambles. Similarly, licensed manufacturer will also have higher risk. They are a little bit less than normal, but they are not having limited risk. And this characterization, which is towards the end of the table, is very important from a transfer pricing perspective. So these are the criteria which you look for a manufacturer. I'm leaving you with something for a distributor and also for a service provider. With this, let's go to the question of what are the issues on FAR. What are the issues which are important for FAR? And there's nothing on this slide because the entire issue of transfer pricing revolves around FAR. And as we go on, we will explore why this slide there is nothing, but the entire presentation is actually can be compressed into this slide. Let's go ahead. What I will do is I will hand over the presentation to my colleague Meenal, who champions the economic analysis section at our organization, and she will be the best judge to give you a perspective about the economic analysis. Over to you, Meenal.
Thank you, Tejas. Good evening, friends. Hello, everyone. So, as Tejas has rightly set the tone for how the transfer pricing journey has been through these 21 years, and he has given a very nice example of a baby born into the world of Indian transfer price, Indian regulations in the form of transfer pricing regulations provisions. So, I would like to continue with the same example of a baby. So, as we understood the importance of the FAR analysis, I would like to connect the whole process with the normal example of how baby is born. Whenever a baby is born, there is a pre-born journey of 9 months in the mother's womb for every baby. And I would like to connect this FAR analysis concept with this journey of 9 months. As we all know, as how we want the baby to be born, like with the healthy figure, healthy body, nice looks and everything, we take care of a mother like that. So 9-month journey is equally important for a baby till it is born. So in the similar parlance, FAR analysis is equally important to set how the transactions are structured, how the transactions are designed, how they are getting documented, what are the roles and responsibilities are structured for the participating entities. Once it is all established in the FAR analysis, then the next aspect of transfer pricing analysis is the economic analysis, which gives the result of the FAR analysis. So when the baby is born, the next grooming of a baby or a toddler journey or a journey of a baby till 10 years, 15 years, as we may see, is like this economic analysis concept, wherein we will adjust the things, we will groom the baby as we want it, we'll give sanskar in Indian language term to the baby, so that he will become a good human being kind of thing. So similarly, the economic analysis concept revolves in the TP analysis is like the thing that now the FAR analysis is in front of us. It is provided to us that, okay, this has been defined as the roles and responsibilities for every participating entity. What next? Then the next step is consisting of all these, consist of this process, which is the tested party. Then we have to select the method, then the comparable search, then any kind of economic adjustments, if at all needed, to make the comparable transaction, enhancing the comparability of a transaction, and then the output result, which will be like our 21-year young adult of transfer pricing in the form of a ALP determination. So let's start with the concept of tested party. Basically, what is a tested party is every transaction has 2 or more parties. Then basic question lies at which one to be tested. So here the law already provides a guidelines that least complex entity, that is entity in the overall structure which is bearing a lower risk, for which the reliable data is available for conducting the analysis, and the fewer adjustments will be required, will be the tested party. Why so? Let's understand. We generally give explain this through our golden example in the common parlance with the example of an employer and employee relationship. See, for example, in the place of employer and employee relation, employee is the fixed salaried person and employer is performing the entrepreneurial role. So whenever the business, whether it goes up or down, employer in the form of entrepreneur role will earn at least the super profits or may turn into the losses. But the employee, for the employee, the results will not be the same. Results will be only in the form of fixed salary. Bonus will again be the varied component depending upon the results of an enterprise. But until the enterprise is shut down, employee will be receiving the fixed salary. There will be the limited risk and responsibilities assigned to the employee, but the employer's return will not be limited for any kind of thing. He can earn anything or everything. That is the whole concept. Here is also in the form of tested party. And again, here also then the least complex entity is easier to analyze, and therefore the least complex entity needs to be selected as a tested party. Indian transfer pricing regulation says so. Even ICAI guidance note has emphasized the concept of foreign entity can also be accepted as tested party. So it is not in case that when we are operating in India, the Indian entity always should be the tested party. It might be the case that foreign entity is bearing lesser risk, so we can select a foreign A also as a tested party. OECD guidelines, UNTP manual also emphasize the same aspect of lower risk and the availability of data. But then why there are issues regarding concept of foreign A's recognizing as a tested party in India? There are several rulings in both of the views. There are diverse views. Many of the times they have not been accepted as tested party. But the underlying reason for rejection of foreign entities as tested party is because of the availability of data. We'll see subsequently what its connection has with the availability of data and how it affects the overall analysis. And that's why many of the court rulings have gone against selection of the foreign A's as the tested party. Again, safe harbor rules have indirectly provided us a guidance for selecting foreign A's as tested party, because in 2017, when they have been revised and they have added certain new transactions like low value added services, they have recognized the markup of 5% which is allowed for the low value added services. In India, in majority of the cases, in case of inbound transactions, the foreign entities are providing the low value added services to Indian participating entities in a multinational group. So then this 5% applies to those foreign entities who are incurring cost and then applying the 5% markup. So in this case, you can see that indirectly ITPR has also recognized that yes, foreign tested party can be a foreign entity can also be considered as a tested party. Then the important factor comes into picture, which is the next step. Our baby has become a toddler now. So which of the methods to apply to complete our analysis? So now we know the tested party whose data needs to be tested, but what method will we have to choose will determine what process to be followed in the next steps. So there are certain traditional transaction methods and traditional transaction profit methods. So you can see with the arrow, the left side, it becomes the product comparability, which is more important, and on the right side, functional comparability becomes important, where the product comparability is little bit has gone on a flexible side of it. So there is no hierarchy or preference of method. These are the listed methods, and then there is the sixth method, other method also, which is a little flexible form of a cup method. We'll see it later again. However, considering while at the time of selection of these methods, again, as Tejas has time and again placed stress on the FAR analysis, and as we have also linked the similar example in our journey of a baby, that how the mother has been the happy throughout the process, how she was feeling healthy throughout the process. Then the baby has born healthy with the healthy mind and healthy body, and now we are grooming the baby with the good things around him, with teaching good things, giving him good environment to become a good human being. So the process continues as like the same. So then, while selecting the method, these are the 6 methods: CUP, RPM, CPM, PSM, TNM, and the other method. So these are the commonly used transactions for which the CUP, all these methods have been used. I'll not go into much of the detail at what is the CUP method and RPM. we have all been seeing through it that CUP is relating to the product comparability, strict product comparability. RPM is related to the distributor nature of thing, wherein taxpayer are the participating in entities are not adding any significant value to the product. Costless method reflects is more easy for the entities who are into the manufacturing of finished goods or semi-finished goods or even provision of services. Profit split method will be good for the entities who are engaged into the integrated services, wherein they may be involved in the formation of a unique intangible, but exact contribution or exact role of the entities cannot be segregated in a way. So then in those cases, PSM can be used. TNMM is always the most likely and widely used method because it can accommodate various functions or roles performed by an entity, because the indicator to measure the profitability is lies at a net level, wherein all the expenses and all the incomes are already considered to arrive at net level or operating level profitability. And other method, jiska koi nahi uska other method. So for the transactions wherein we generally don't get the strict product comparability available, the strict transactional level data available, then with somewhat flexibility, the other method can be used. Then what are the issues? This looks very simple when we see the widely used international transactions with the type of methods. But then the issues faced are like, in case of CUP, as we say that product comparability is at a strict level, then the lack of internal or external comparable data becomes the crux of the issue. There may not be always available make an apple to apple comparison where the apple should be equally read with my apple. So it may not be possible to have such kind of external comparable data. And even the access to the specific databases every time, or maybe the foreign databases every time, is not feasible for every taxpayer or every participating entity. Then in case of RPM or CPM, generally, though the data is available in the form of financial statements to arrive at a gross margin, every entity follows different accounting policies. There are differences in disclosures of various accounting policies. So then uniformity to arrive at or calculate a gross margin becomes sometimes difficult. So that would be the only issue for using the RPM or CPM methodology. PSM is why it is rarely used methodology is because of the complexity involved in the integrated functionality of such kind of transaction, where various entities from a multinational group are involved in a particular transaction. So there will be high confidentiality of data disclosure. So there will not be the participating entities may not be willing to share every confidential part of the data with everyone. So the difficulty in application of method comes into picture, and therefore we can see that over these 21 years, PSM is the only method which has been least used in the overall TP analysis. Then the TNMM method, as I earlier said, we arrive at a net level profitability or operating level profitability, which accommodates almost any and every kind of transaction. So TNMM is a little bit easy to approach to for having the comparability, where the product comparability is not as much necessary and we can rely on the functional comparability. So then the issue arises again is the combined transaction approach, that is the aggregation approach versus the separate transaction analysis approach. Taxpayers generally adopt this aggregation approach vis-a-vis. Revenue authorities would like to adopt the transaction level approach, and they may reject TNMM analysis and go for the separate transaction analysis for the same. Then the other method, as I said, jiska koi nahi uska other method hota hai. This is the common practice we have been experiencing over these years since the introduction of other method. But the commonly faced issue I would like to mention here is that it should not be regarded as a residual method. We should go into the facts of the case again. Time and again we are emphasizing on the FAR analysis. We should structure the FAR analysis. We should design the FAR analysis in such a manner that would justify the applicability of any of this method, whether it would be a CUP method, whether it would be a other method. Of course, depending on availability of data, we can select the method. So with this, we can see that there are certain other issues like in the selection of methods. It's where the use of internal comparables preferred over external comparables. Of course, yes, internal comparability always would form a better comparability because it is in the same organization or same mini group if there are availability of transaction between controlled and uncontrolled scenario, it would be the best kind of situation. So there are few rulings who have emphasized this, that internal comparability would always be first tested, and if it is not available, then we should resort to the external comparability analysis. Again, the product comparability over the functional comparability. Naturally, TP is all about finding the exact comparability. So product comparability becomes strict in case of other method, in case of cup method, and little flexible in case of other method. So if the product comparability is available, again, like internal comparability over the external comparability, similar is the preference for the product comparability over the functional comparability. Underlying FAR analysis will always guide us towards whether we should go for the product comparability or leave it aside and continue with the functional comparability. Then there is important issue of disagreement on FAR. Yes, our FAR analysis is always being a crux of the TP analysis. So how the FAR is justified, documented will depend whether the characterization that we have agreed is similarly agreed by the revenue authorities. So if I'm saying my particular entity is bearing normal risk, or with, for example, bearing a limited risk, but my FAR is not properly documented and justified to that extent, the revenue authorities may contend that no, it is in the form of normal risk-taking entity, and the other consequences of it will follow, because then the method, then the selection of comparables, then the overall PLI analysis would go at stake once the characterization itself is changed. Then the next important process comes for the search of comparables. Okay, now we have selected the tested party, the method. Okay, so method will give us the guidance how to proceed for searching for the comparables as a process. So there are three aspects of it: sources, filters, and the final selection process. Naturally, sources would be the first internal sources, external sources. Internal would depend on the discussions with the management or details which we can internally obtain from the participating entities. And external sources will always be the publicly available databases. Like in India, there are Proves, Capitline, ACE. There are certain foreign databases like OneSource, Bloomberg, Comstat, Amadeus. There are also special transaction related databases like Royalty Stat, Royalty Range, or KT-Mine. Other than this, there are certain also external sources available in India for the listed companies like BSE and NSE website, where we can get directly the annual reports. Also for private limited companies, we can refer to the MCA website where we can get the annual reports. So with all these sources, we can find out the data for our comparability for the external comparables to which will form the uncontrolled transaction scenario. So then comes the aspect of filters. We have, for example, Proves itself has more than 50,000 companies in its database. So can we go through each and company for selecting that whether it is a comparable for me or not? No, this is not possible. So we have to apply certain filters based on which we can get broadly similar or potential comparables list, which will be feasible for us to analyze in detail. So there will be application of some quantitative filters like sales, net worth, ownership. Then there's specific operational level quantitative filters, like for manufacturing companies, some ratios will be applied. Similarly for distribution, and similarly for service providers. Then the qualitative aspect comes into picture, which will be again based on the understanding of our FAR, whether the companies are consistently loss making, whether they are having segmental data disclosure, which will be more attributable or comparable to our control transaction, whether their website also speaks of the similar kind of business description which the annual report depicts. This kind of filters this kind of analysis in the qualitative form will help us to get the potential comparables for the final screening. And again, the final screening will consist of the related party transaction screening, because whole TP concept lies based on the premise that we are comparing the controlled transaction with the uncontrolled transaction. If we are getting the comparables who are also having the similar controlled transaction scenario, we cannot select them as a comparable. Then the analysis will not give any fruitful results. So again, this RPT screening becomes an important. Then there, if any adjustments are needed, then we have to calculate the indicators basis on which we determine the results of our analysis, and the use of data, multiple data, etc. So then you will see that the process is quite simple and there is nothing complex steps involved in it. Then why the issues arise? for this simplified process. So the issues we can see in case of sources are that there are many times Indian databases are easy to access in India, but the foreign or specific databases may not be accessible to everyone in India at any point of time. So that generally the issues revolve around the use of database is due to the access of database. Then there is use of secret comparables. There is one provision in ITPR which gives authorities to the taxpayers, tax authorities, which gives right to the tax authorities to select the comparable data which is generally not available in public domain or the taxpayers easily. Then there will be disagreement on selection of such type of comparables from the taxpayer side. Then there are use of broader comparables. Why broader comparables and why not exact? So there might happen a situation, there might occur a situation where there is where the participating entities involved in some niche kind of product or specific product for which we may not find the exact comparables from the databases. So in that case, we need to broaden our search and find out the broadly similar comparables to the whole analysis. Then there will always be disagreement or issues in respect of different application of different filters, maybe the range of filters. Like I will select the turnover filter of say upper limit of 200 crores. The tax authorities will not argue on that. They will select 10 times. Similarly, the other ratios they may add the other proportions like employee cost filter, foreign exchange earning filter, and like that. So there will be different application of filters which might create issue at the time of assessment or justifying our analysis before the revenue authority. And again, the availability of data for the potential comparables. As I said, in our foreign use of foreign databases, this might be the issue that because the final comparables, maybe annual reports for the foreign entities are not available in public domain. We just get the some extract of financials from the database, which may not be authenticated. So such kind of issues arise from the database perspective. Then the selection processes, as I said, RPT screening becomes important to make sure that we are comparing the controlled transactions with the uncontrolled one. There has been always different methodologies followed for the ratios to compute the RPT as well. As I said, there are different criteria and ratios are used in case of quantitative filters. Here are some listed filters. As I mentioned earlier, the sales, there are different criteria. Safe harbor rules also provide certain different criteria to consider for sales. So then there are commonly used filters like 75% of manufacturing sales, 90% of service income to get the broadly similar or closer comparable, or to have a good functional comparability to arrive at potential comparables. So use of these quantitative filter helps in shortlisting of the appropriate or closely potential comparables we can see in the overall analysis. Then becomes important for once we identified the comparables, what data should be used for the comparability analysis. Till 2015, it has always been this area of dispute whether to use single year data or the multiple year data. But the life has become simpler in 2015 when Rule 10C was inserted, and now the issue has got settled because use of multiple year data has been allowed. It is not allowed in case of methods like CUP, PSM, and other methods. These methods still demands the use of single year data only because of the inherent nature of the applicability of these methods. Then multiple year data has come along with it, the range concept, which is a fantastic concept which has widened the range of comparability for the participating entities, as it has not remains restricted to the arithmetic mean concept, and it has given the basket of 35th percentile to 65th percentile of the database to consider as an arm's length range. And even if the arm's length result of a transaction falls beyond the range, beyond this data set, either this side or that side, median will be considered as the arm's length margin. So does that mean that arithmetic mean has gone out completely from the ITPR? No, it is not, because the range concept is applicable only where the 6 or more comparables are involved in. If the comparables are less than 6, arithmetic mean still is valid for application. Now the life, as I said, life has become simpler from 2015 because of the multiple layer data applicability. But does that mean that rule 10B, 10C, and 10D restricts us or taxpayers to use the single layer data till date as of now? So there is a little ambiguity regarding that when we have the plain reading of the sections or rules, that in case of even in case of specific years, whether we can apply single year data or we'll still have to consider the multiple year data is not clear as of date. The time coming time will tell us what will happen in that case. Then once we are done with the use of data, then what profit link indicator or what indicator we should use to compare the controlled transactions with the uncontrolled transactions. These are the some of the formulas or profit linked indicators which are used in different kind of methods, as you can see in the slide. So there is no typical specific guidelines provided for the applicability of particular PLF for a particular method. There are very broad guidelines which are provided. These are the formulas which have been evolved as a result of experience and analysis of taxpayers and tax authorities over this 2-decade journey of transfer pricing till date. Then computation of PLI. Computation of PLI involves various aspects such as there are various components of profit and loss account of participating entities based on which the profit link indicators are computed. Again, it looks as a simplified process, but then the issues or common disputes revolve around the operating versus non-operating concept. To put it in a simplified manner, basically what should be included for calculating a profit link indicator and what should not be is the dispute with respect to the operating and the non-operating concept. So there are certain components which is like foreign exchange fluctuations, provision of uncertain liability, government grant, liquidated damages, where there are the common disputes arising. So crux of this all lies is the pricing policy or the mutual agreement for which the two participating entities have agreed between each other. Based on that, we can decide a treatment for such items like forex impact, government grant, liquidated damages. This typically comes out of the pricing policy and agreement between the parties. Again, for government grant concept or uncertain liability concept, taxation part of it also becomes an important aspect. Typically, safe harbor rules provides a guidance where these forex fluctuations, uncertain liabilities are not treated as operating items in the safe harbor provisions. Then we have listed these some case laws where they have been taken. Courts has always been taken a diverse views, whether when it comes to the operating part of it or non-operating part of it. Again, the crux lies in the pricing policy. So whatever has been agreed between the parties becomes important to decide, and it will be completely a fact-based exercise for a particular entity to consider this foreign exchange impact, whether operating or non-operating. Similarly, there are diverse rulings for the provision of bad and doubtful dates. But if you go through all these rulings later, you will understand where in various rulings they have considered as operating, it was on a basic premise that it was directly related to international transaction or the core business operations of a particular entity. However, where various court rulings have considered it as non-operating, the basic premise they followed it as the provision is relating to the previous years, and so from deducting it from the numerator itself, where the denominator of the sales is related to only the current year sales, it will create a discrepancy or it will create a mismatch. Only out of this contention, the various rulings has considered this provision for bad and doubtful dates as non-operating. As I said, there is guidance provided in safe harbor rules. What all will be included in operating income or expenses will be excluded. We can always go and take a guidance from the SHR, because companies opting for the SHR will normally has to mandatorily follow it. But if we are not opting for SHR, or if we are not covered under the SHR mechanism, what will one should do with this inclusion and exclusion? Then I think when we are typically not covered in SHR, in our view, it has only a persuasive value, it has only a guidance value. We can always take a guidance from the inclusion and exclusion items. So it need not be mandatorily applied. It cannot be mandatorily applied since we are out of the SHR scheme if the taxpayer is. Then the important concept is of economic adjustment. What adjustment, if at all, is required to enhance the comparability between the uncontrolled transaction and a controlled transaction? So one has to identify the material differences between these two transactions, controlled and uncontrolled. if at all, if we can identify with the sufficient accuracy that whether these adjustments can be performed and the comparability can be enhanced, yes, then the next step comes into picture. If not, then it naturally gives us the picture that the comparable is not the right comparable. So should not go ahead with that. If no adjustment needed, that is the best case. That will be the best case for the analysis. If the adjustments are needed, with what sufficient accuracy we can perform it, we'll perform it with the reliability of availability of reliable data for performing the adjustment. So these are the rules where the economic adjustments have been referred, and even the court rulings and the ITPS suggest that economic adjustment should be performed on the comparable transactions. But there are few rulings as well over these years in which the court has concluded that adjustments should be performed on a tested party. Time and again, it has been observed or experienced that it is difficult to apply in various cases to apply the adjustment on a tested party. It is easier to apply on a comparable thing. Then there are a few types of economic adjustments which one can refer, like working capital adjustment, capacity utilization, risk adjustment, and depreciation adjustment. These are some widely used adjustments. Working capital will help to neutralize the impact of working capital cycles, which will have on the profitability of companies. It is always wherever we are considering the adjustment part of it, it should always enhance the comparability aspect. So whether a negative working capital adjustment is possible, which will have impact on naturally increasing profits of the comparables. So ideally no, but then that becomes important when there is an issue of unusual outstanding receivables. So in such cases, we need to again go and see the detailed facts of the case and whether the working capital adjustment will result into the finding the correct arm's length margin or correct arm's length price for a particular analysis. This fact-based exercise will give the answer whether to perform this particular adjustment or not. Similarly, for the capacity utilization adjustment, it will naturally, as the word suggests, occurs due to differences in capacity utilization. For example, one of the participant entity is into the startup stage maybe and getting compared with the established industry players wherein they are on the optimum utilization of capacity stage, and when the startup will hardly have 20%, 40% capacity utilization. In that case, we have to analyze certain factors based on which this capacity utilization can be adjusted. It was easier till 2012 because Schedule 6 requirements had made mandatory for companies to disclose the capacity utilization data. But post 2012, it has become difficult because the mandatory requirement has gone with the revised Schedule 6 requirements in Companies Act. And then now it has become difficult to get the exact availability of data. For the tested party, it would be easier, but for the comparables, it becomes difficult. Then one has to rely on certain assumptions, one has to rely on certain other factors, which will be based on certain formulas like fixed cost, depreciation impact, etc., to arrive at the capacity utilization adjustment. Then there is risk adjustment, depreciation adjustment. Again, the risk adjustment will relate to the lowering the impact of the difference in risk profile. But here it lies the important concept, as if the risk profile is considerably different between the controlled and uncontrolled transactions, the comparability itself may go to at stake, that the particular entity will not be directly comparable to me if there is a significant difference in our risk profile. That may not be adjustable. So even if we go to the court rulings which have allowed the risk adjustment, have either ad hoc allowed the 1%, 2% risk adjustment, or they have used certain formulas like the capital asset pricing model or some other factors. So, but over the years, we have experienced and observed through the court precedents that risk adjustment is the least used and least resorted to adjustment because it's difficult nature to apply in the practical scenario. Then comes to the depreciation adjustment. Apparently, it looks a very easy adjustment to go for and to perform for, because it is all revolving around the difference in the depreciation policies arising out of the difference in accounting methodology, differences in disclosures. Maybe the period is different, maybe the methods are different. But when it comes to the application of the adjustment, performing the depreciation adjustment, it is somewhat difficult because one may not take account for the timing difference, because of which the depreciation adjustment comes into picture. And one would make the adjustment in 1 year, but what about the next years, subsequent years, where the situation may get flipped? So then one, over the years, no one has looked into the concept of depreciation adjustment applied to the block of the years. So one cannot apply the adjustment only in 1 year, and the subsequent year are just left as they are. So this would not be the right way. So this also aspect also needs a due consideration or a detailed analysis to whether we can rightly perform it for a 1 year, or whether we should take the impact of the earlier year's adjustment into the next year's cases. Then these are the several rulings which wherein the courts have allowed the various adjustments. Again, the judicial pronouncement has focused on the granting of the economic adjustment, but none of the court rulings, or very less court rulings, have really provided guidance for the computation mechanism for these adjustments, and they have just granted the adjustments on a principal basis. So that again leaves for gap in understanding for the other taxpayers that how exactly it should be performed, or what will be the right way to perform all these adjustments. Then this is the last adjustment, but it is somewhat really different from the economic adjustment we have discussed, because this is the result when the transfer price of a transaction is not equal to its arm's length price. When our whole analysis go in vain, and the tax authorities will deny our transfer price analysis and will say that your price is not at ALP, so I will calculate ALP and I will make an adjustment. So there will be some primary adjustment either done by voluntarily by taxpayers or by TPOs in assessment, or it might be the result of entering into the APA process, or opting for safe harbors, or entering into the MAP settlement process. This primary adjustment, when it goes into excess of 1 crore, then the secondary adjustment term comes into picture. And the whole crux lies of the secondary adjustment is whatever is agreed for enhancing the transfer price from the original transaction price to the actual arm's length price, the differential money should flow to India. Excess money available with the A should be repatriated to India within the time limit prescribed. So in 2019, Finance Act has also amended and additionally provided the provisions that excess money, if not repatriated in the prescribed time, the 18% income, 18% interest will have to be considered as income, and which would be taxed in the hands of the taxpayers. So that becomes that is how the secondary adjustment is important when the primary adjustment is more than 1 crore and in any of the following situations. With this, I think we have understood the economic analysis as a whole overall process as a concept. So our baby has born, we have groomed the baby, and as we know, the TP analysis is followed from the teenage years, and it's now the 21-year-old thing. Now, how the adult is behaving in various issues, key transactional issues, this will take you through all this. Thank you very much.
Thanks, Meenal. I think Meenal has explained us the concept of economic analysis in a very lucid manner. We just, I think in various slides you would have seen that we have FAR analysis has been one of the key places where she has been emphasizing. So whether it is the concept of tested party, where she was mentioning about who is the employer, who is the employee, so who does what becomes important, who bears what. So the employee, the way she said, bears the risk, vis-a-vis the employee does not bear the risk. So these questions have time and again kept, and therefore the question of FAR remains very important in the overall transfer pricing analysis. With that, what we will do is we will dive into certain transactional issues now. And what we have done is we have handpicked certain transactions which are very regular in that sense of it and not very unique, but nonetheless miss the eye of normal taxpayers when they're doing the transfer pricing analysis. So we'll start with the issue of outstanding receivable. As the name suggests, the question is you do a transaction and then there is outstanding, which is either payable or receivable. So example, when AE in India is selling or exporting certain goods to its AE abroad at 100 rupee or $100, there is going to be a resultant transaction which is there, which is that the AE has to pay us $100. How soon or how fast they pay becomes the outstanding receivable. So the concept is whether unusual, the word which is important is unusual, outstanding receivable amount arising out of an already disclosed transaction, say export, should be considered as a separate international transaction. So the dispute has always been among that whether outstanding receivable amount for outbound transactions, and I'll explain that in a minute, should be considered as outstanding receivable if it is not recovered from the AE within a reasonable amount of time. So why I said that for outbound transaction, when I say outbound transaction, that is income-based transaction. So example, export, provision of services to group entities where money is going to come from them to India. For places where money is going to, that we have to pay them and we don't pay them, actually this concept becomes a little bit redundant because section 92(3) kicks in where it says that any, the provision says that any impact, any kind of transfer pricing provision which has the impact of reducing the income in India does not become applicable. So any amount where Indian entity has to pay the group entity is not paid in a particular amount, it doesn't become a big issue in the hands of the Indian entity. So again, coming back, whether any unusual amount, outstanding amount arising from an already disclosed transaction, say export, should be considered a separate international transaction. Export transaction in my example is already disclosed in form 3CB, either in maybe the clause 11A, B, C, depending on whatever is the nomenclature, or 13. The question is the AE has not paid me within a reasonable amount of time. Then what should be the analysis? Whether it remains outstanding receivable or the characterizing now changes to a loan that is given to AE. That is very important in this question. So the moot question is that whether outstanding receivable remains a transaction or it becomes now re-nomenclated as a loan. Points to consider from our side, I think whether the amount has come in normal credit period, if it has come in a normal credit period, just follow this chart, not an international transaction. If it has not come in the normal credit period, that is whatever is defined in the agreement, etc., then you look at the other possibilities. Then there is the first thing which you will notice is that I have given I had offered them a credit period of, let's say, 100 days. And they gave me the amount, let's say, after 1 year. Oh, then the 365 minus 100 days, that is 265 days. What has happened to that? Now, this question is, after 100 days, whether this amount becomes a loan. And here, the next analysis is that, which we need to do is you perform a working capital adjustment. What does it mean? I think Meenal has already explained it in the economic cycle. But what happens is when you're pricing a transaction, this is an outbound situation, you're pricing a transaction, the price that in my example of $100 would be based on the premise that I will receive the money in 100 days. And if the AE has given that money after 1 year, then the extra interest, who should bear it? It could be a situation where that, let's say the dollar has gone up and that dollar has gone up significantly, because of which I have received more money into India. So what you do is that you do a working capital adjustment to make sure that your margin after doing those working capital adjustment is in line with that of comparables. So again, going back to this table, margin is outside range. Then the answer is that, oh, after doing the working capital adjustment, the margin of my comparable companies is outside range. That means I have made lesser profits than that of comparables. In that case, you need to more likely than not only disclose it as a outstanding receivable as an international transaction, but also you may have to do a adjustment in your transfer pricing. Now, whether it should be based on LIBOR or it should be based on a difference between the tested party margin is a matter of detailed transfer pricing analysis. And again, it goes back to the way the agreements have been structured. So simple point that with respect to outstanding receivable is that you try to do a working capital adjustment, and if after that also you're not fitting within the arm's length range or your margins are outside the range, more likely than not it is an international transaction which needs to be reported. Point to consider here is post finance bill 2012. This is definitely international transaction. Only thing is when you do a transfer pricing addition is something where you don't fall in the working capital adjustment, then you might as well do a transfer pricing addition. So this is on the case laws and the rulings with respect to outstanding receivable closely linked with the main international transaction, or outstanding receivable as separate international transactions are already mentioned here. The concept is something which I just now mentioned to you in the slide. The next issue, which is very commonly, which is making rounds, and right now it is pending before Supreme Court. Amounts at stake are very high. In the common parlance, like the way transfer pricing is defined, the issue is with respect to AMP expenses. Also, it is known as marketing intangibles. So the word AMP, marketing intangibles, are used very interchangeably. What is the issue? Whether incurring of unusual AMP expenses, and the word AMP stands for advertising, marketing, and promotion. So the question is whether incurring of unusual AMP expenses can result in provision of a separate international transaction. This is the question. Whether it is important to look at such expenses separately, or important to look at the characterization of the overall pricing policy, which all type of expenses should be considered for such analysis. So whether advertising, marketing, selling, distribution, all of them should be considered, or only advertising, marketing, promotion, which are directly expenses, should be considered. Before I get into our points or key points for consideration, there are 3 landmark judgments which so far in this regard. This issue all started and became very famous with the LG ruling in case of ICAI special bench. In the ICAI special bench, they dealt with this issue and they said that yes, AMP is an international transaction. They also introduced this concept of bright line test. What the BLT is bright line test, and what it means is that, example, they in case of a distributor, they compared the AMP expenses as a percentage of sales for LG as well as, let's say, the comparables which they selected. And what they found is LG had got AMP of, let's say, 10% and the comparables at 2%. So difference between two is something which they added back to the value of transaction. So the LG ruling is something which is a landmark ruling, and where the first, it said the subsequent rulings where AMP became an international transaction in most of the cases, and then across India in all the cases they started looking at AMP as an international transaction. Of course, subsequently we had these judgments which came from Delhi High Court in case of Maruti Suzuki and Sony, which actually in a way overturned the judgment of LG to a larger extent. Of course, the key judgment is that in case of Maruti Suzuki, AMP is not an international transaction, is what they mentioned it. Also, they rejected the concept of bright line test in case of Maruti Suzuki. This question of bright line test was also rejected in the case of Sony. But in case of Sony, the question of whether AMP constitutes an international transaction was something which was not evaluated. Before I get into this discussion, let's look at the points for consideration. The review, and in the box below, review of agreement and other relevant document relating to marketing intangible. That is very important. So whether a question comes to mind is that if there is an agreement for AMP reimbursement, whether it becomes directly synonymous with the fact that I have an international transaction, in our view, no. You need to do further analysis and a FAR analysis, and a detailed FAR analysis and correct characterization to be documented. So I'll give you a very simple example. In India, a lot of these distributor entities are working on a cost plus basis, or let's call it a resale minus basis, because they are a distributor. Now what happens is they are assured a margin. So whether I incur 100 rupees or I incur 1 crore or I incur 1000 crore, it just doesn't make a difference, because at the end of the day, I'm going to make a margin of 2%. So the question should only remain that whether the 2 is right or not. And while you're selecting the comparables, I think for the 2, my view is that you should have comparables who have got similar kind of AMP expenses. So that is the way you tackle the issue of AMP, at least when you're dealing with that. Secondly, whether I need to get a reimbursement directly by way of a direct international transaction, or it can be embedded in some of the other international transactions. I'll give you a very simple example which I always use. I have started an ice cream shop for Amul here in Pune. Amul comes and tells me that why don't you incur 1 crore of additional expenditure and you promote the brand Amul in your area, you can use it for whatever purpose. I say fine, I will do that. How are you going to reimburse me that? So Amul says that okay, I'll give it to you by way of reimbursement. That is one way of doing it. The other way is that I realized that they say that normally we give you a gross margin for other distributors which is only 2%, but because you are going to incur these expenses which are unusually high, I'll give you 20% gross margin. So what has happened is, instead of giving me direct reimbursement, they have given me better GP, and the more sales I do, I will recover that expense which I'm going to incur by way of higher gross margin. So always it's important to understand that the concept of AMP need not be dealt as a separate international transaction. It is important to look at the FAR analysis, that how they have, who does what, who pays me what, and who's giving me and who's employing what. Also segregation of AMP into brand, the brand expenses. So example, I have whether just all these Pepsis of the world, Coca-Colas of the world, I'm sorry, they are incurring expenditure for employing Shah Rukh Khan or some of these famous celebrities, whether it becomes a pass-through cost, and my service aspect remains only to the extent of actually appointing them or identifying the transaction. That is also something which is important when you're looking at AMP. Sum and substance, the AMP issue is here to stay. I think we are waiting for the Supreme Court ruling in our case. Point to be noted is that a detailed FAR analysis, and you have to look at the entire transaction, not only the AMP transaction. Whether my GP is more is something also important to see. Whether I've been given a net profit, whether I'm a low risk distributor, I'm getting a gross margin or I'm getting an assured net margin. All these things play a very important role while determination of AMP expenses. The next very common issue, which is royalty and intra-group services. Royalty, I think I need not get into the concept. Simply put, payment made towards use of technology, brand name, or use of intangible is usually based on sales. Similarly, the concept of intra-group services, as the name suggests, the nomenclature is payments made for availing either generic, that is management services, or specific services. It is a very common phenomena in multinationals that there are centralized services being provided from the group, either with respect to accounting, IT, etc. And therefore, they are charged from they are cross-charged by the group entities to Indian entities. And it also can be an outbound situation. But what happens is the issue of royalty and intra-group services is very close to the hearts of the tax authorities. One, the tax authorities always ask, the first issue is demonstration of the need for service. What they say is, why do you want to pay royalty? Why do you want services from? So they always ask this question. In my view, need is something which the tax authorities cannot really question, and there are umpteen number of decisions which are there on the subsequent slide. Second is demonstration of proof of rendition of services. I think this question is a bit valid, that because I have to prove that there is some service being provided. Ideal to maintain some documentation, mail, visit, call logs, presentation, maybe engagement letters or whatever agreement copies, which prove demonstration of services. Also, it is important to note that in certain situations, service may exist without rendition. So example, big companies, it's seen very commonly in India, they have a panel of lawyers on retainership basis. You may or may not avail their services during the year, but you still have to make the payment. That doesn't mean that the payment made for the retainer fees is going to be redundant payment per se. So all these things are also, it's important to understand that the service may not always be, there may not be a proof for every time, but what is important is the agreement copy, or at least let's say the intention to receive certain services, which needs to be documented. The third question or the third issue is demonstration of tangible benefits received. What does it mean by way of tangible benefits received? The question revolves around benefits. Every service need not really result in a benefit. I don't know, what is a simple way? Filing of income tax return for a CA. Somebody may say I can file it on my own, or it is a compliance for me. There is no benefit coming to me. I can do it on my own. But this is a compliance. I have to go and get it done. Yes, I personally feel there is a lot of benefit which I can add a lot of value to the service. But the client may or may not pay. So the benefit, in my view, every service need not result in a benefit. But some demonstration of benefit may be necessary in certain situations. So example, if you're making a payment for accounting services, you may need to document the proof, and then broadly what additional knowledge you received could be a benefit that you received from the group. So example, a lot of times these resources which are there abroad, they are all knowledgeable resources. They have seen businesses, and over calls they will give you a lot of these advices which help in taking the company's decision faster. Even that is a benefit which you can document in your transfer pricing analysis. Question comes down to emphasis on quantification of benefit. Quantification, in our view, is not essential, and whatever quantification is possible should be from a taxpayer perspective. It should not be from the perspective of the tax authorities. Also, I think when it comes to quantification of benefits, I personally believe that we have to go back to the methods, because ultimately the methods are for quantifying the benefits, or are there, if I'm able to demonstrate the arm's length value of the transaction based on one of the 5 or 6 methods, I think that is more likely than not the quantification of benefits. So a detailed FAR analysis again here would be helpful while quantifying the benefits. Last point is aggregation approach is rejected for the purpose of determination of arm's length price. So aggregation, in my view, and when we say aggregation, as we discussed towards the beginning of the presentation, aggregation is when you club all the transactions together and determine one price of it. So whether it is royalty, intra-group, sale, import, you look at everything together, and then only then one price is determined. My profitability is compared with the profitability of comparable. What happens is this is a bit of a bargain, and what happens is a bit of a gamble that one is taking, because in the year of profit you will be good, but in year of losses it becomes a big gamble. So aggregation should be used as a last resort for such transaction. In our view, you use, so in case of royalty, you have specific databases. You may or may not have access to them, but I would still urge that you use specific databases or specific transaction analysis for the transaction of royalty and intra-group services. I'm leaving you with the rulings for royalty and intra-group services. Most of the rulings say that commercial expediency, that is no need to demonstrate commercial expediency in case of royalty or in case of intra-group services. Benchmarking of use of transactional data as well as TNMM, there are both rulings. Nonetheless, the recent rulings are more emphasizing on the fact that you should have a specific benchmarking done for a particular transaction. With that, we move to the concept of financial side of it, that is intra-group loans. Loan per se is a very simple transaction. We understand it very easily. There could be 2 types of loans. One is inbound loan, outbound loan. What is the inbound loan? Loan which is provided by an AE to the Indian company. So AE, that is foreign entity, provided to an Indian company. Normally, we have seen that these are foreign currency denominated loans, because they would be either USD or Euro or some of these Swiss franc which are there. And rarely you will see that they are interest free. Outbound loans provided by Indian companies to their group companies outside India. So example, Indian company like Indian, and more likely than not, we'll see it in Indian headquartered companies like Infosys of the world, Tata Motors of the world, which are Indian headquartered companies which are providing loan to the group entities. Could be foreign foreign currency loan or rupee based loan. And normally, we have seen that these could be interest free or interest, and some interest is charged. What happens is they become interest free when they are shareholder loan, and this is where the issue rises. So what are the key issues and points to consider for that? Inbound loan as well as outbound loan is something which we'll quickly go into. Inbound loan, whether the benchmarking of foreign currency denominated loan with a Indian PLR instead of similar base, that is LIBOR, etc., is right. So the question is, AE has given me loan which was LIBOR based, LIBOR plus let's say 200 basis points, and the tax officer is benchmarking this, or for that matter, I should not even go to the tax officer, even the consultant or the company is benchmarking that by comparing this loan with, let's say, SBI loan or SBI PLR. Whether it is the right approach, well, I don't believe so, because in one case there is a risk, that is in a LIBOR based loan there is going to be a risk of foreign exchange, whereas in the case of SBI or a PLR loan there is not going to be a foreign exchange, unless and until you are able to neutralize the effect of this. Personally, in our view, foreign currency loans should be benchmarked with similar base. So if you are getting a LIBOR based loan, there are these specific databases like Bloomberg, etc., which Meenal mentioned in a presentation, which we should use for the purpose of benchmarking. And then I think use of FEMA rules. So what happens is in FEMA, in case of inbound loans, there are certain ceilings, all cap ceilings which are there. Whether we can use this all-in-one ceiling rate for benchmarking purposes, well, in our view, it can be of persuasive value. However, specific benchmarking exercise, considering the key covenants of the terms, like the term of the loan, credit period, duration, etc., become very important while determining the loan. Because a person who doesn't have any credit rating, he may not easily get a loan, and therefore in such cases the interest rates would be on the higher side. Then in that case, the FEMA rules or the all-in cost ceiling of FEMA may or may not become applicable. Outbound, the issue is very similar to inbound, but what happens is whether to use the Indian PLR risk-free rate for benchmarking, that is the opportunity cost of foreign currency loan. Again, as I mentioned, if it's an Indian based, it's an INR loan which we have given, then we should use INR as the base. But if it's a LIBOR base, we should use a LIBOR as the base. So LIBOR or any other foreign currency loan. Also, this is coming out of the safe harbor, because in case of safe harbor loans which have been given, they have mentioned the criteria remain the same. Foreign currency, Indian loans, Indian loan has been mentioned there. And interest-free loan. This is a bit of a tricky topic, but important to know, if the Indian entity has provided interest-free loan to foreign entity, then robust documentation is needed to demonstrate the rationale. So why it becomes a shareholder activity? So very simply put, if Tata Motors, let's say, decides that they float a subsidiary outside India, they only decide that we will let them take a loan there on our behalf. I will give guarantee. Let them take a loan, and not more likely than not resonates the fact that it is it's a shareholder activity, and then it is at my behest that they are taking a loan. In that case, whether I can give a share interest-free loan becomes a matter. Of course, it leaves with other questions about the taxability of the interest which I will be bearing on this, but that is not a matter of transfer pricing which I'm discussing on this slide right now. Lastly, I think LIBOR has been discontinued from December 2021, and then these new terminologies you will start finding, which is SONIA, which is sterling overnight interbank average rate, etc., is something which you will start seeing more likely than not. I think the rulings about adjustment on interest-free loan vis-a-vis are already mentioned, are there in this presentation. You can refer to them subsequently. I think with this we move to the concept of corporate guarantee as a transaction. What is corporate guarantee? When one enterprise provides guarantee, financial or otherwise. So there could be otherwise term is performance, product, etc. guarantees. But broadly, this concept has been used in the business world to deal with the concept of financial guarantees. So when one enterprise is providing guarantee on behalf of its group entity to a third party, which enhances the credit worthiness of the other group entity, that becomes a corporate guarantee. As I said, it could be a financial or otherwise. Now the question is, guarantees can be of two types. One is implicit, that is an understanding, and then or a letter of comfort, and explicit, where there is a documentation or agreement which is there between tripartite, which mentions that I am giving guarantee on the behalf, and any kind of debt, liability, or anything arising because of non-performance of the obligations by the group entity, I will take care of it. So whether such guarantee provided by one enterprise to other qualifies as a separate international transaction. If yes, how to benchmark this transaction? First point, Finance Bill of 2012 specifically includes the guarantee as a part of international transaction. Clause 15 of Form 3CB, which was mentioned, also mentions that you need to report the guarantee transaction separately. So I think more likely than not, if you are providing either inbound, outbound, and when I'm saying inbound, outbound, I'll come to it in a minute, corporate guarantee becomes an international transaction going forward. What was the position before 2012? Well, if because of the loose wording of the definition of international transaction before 2012, there are some rulings which say that corporate guarantee is not an international transaction. But I think in today's world, it's very clear corporate guarantee is an international transaction for the purpose of transfer pricing. How to define what is the value is something which we will come to little later. Two types of corporate guarantees like loan, inbound, outbound. Inbound, where the non-resident AE provides guarantee on behalf of the Indian entity. It's the inbound. Answer is very simple: implicit guarantee or explicit guarantee, but nil. You need to mention it in the transfer pricing study report. Also disclose it in the Form 3CB with nil value. Explicit guarantee charged by the AE, disclosed in the transfer pricing study report and Form 3CB, and a benchmarking exercise will have to be done. Again, we recommend here that use of specific databases like Bloomberg Loan Connector to determine the value of this transaction. Outbound guarantee. Outbound guarantee is where a resident Indian company is providing guarantee on behalf of non-resident AE. So example of Tata Motors giving guarantee, let's say, to Deutsche Bank in Germany for its subsidiary in Germany. What it means is implicit guarantee, again mentioned in the TP study report, also can be disclosed as nil in the Form 3CB. In case of explicit guarantee, robust documentation needed to demonstrate, and where I'm saying explicit guarantee but not charge. So there is no charge or there is no recovery. So you need to demonstrate the way I mentioned about intercompany loan, the rationale why it becomes a shareholder activity and I'm not charging. More likely than not, it goes back to the fact that it is my decision in India that I need to give corporate guarantee and that is imposed on the foreign entity. Of course, I'm just keeping it very loosely, but there is a lot of detailed FAR analysis which needs to be done in this regard. Indian courts have been rejecting this view of imposing ad hoc guarantee commission. So you need to do a proper benchmarking analysis, and I'll come to it a little bit in the slide below. In the bullet below. So what is the use explicit guarantee which is charged? You need to disclose it in the transfer pricing study and the form 3C. What happens is when you're doing a benchmarking analysis, you use these databases, which is Bloomberg, etc., where you get directly the guarantee rates. Or actually, what you can do is you do an analysis of what is the credit worthiness of the foreign entity, and then you compare the rate of interest offered by the bank, and the differential is something which can help you demonstrate the guarantee commission. So this is something known as the interest saving approach, which is there in the world of transfer pricing. I'm not getting too much into this, but one matter of caution is that overall aggregation under TNMM should be the last resort for corporate guarantee, because corporate guarantee in an inherent nature is like an interest transaction. More likely than not, it will not get covered in your transfer pricing analysis. It should be used as a last resort for TNMM analysis. Safe harbor rules recommend 1% corporate guarantee, but we will not get into it, because as I mentioned that safe harbor rules, when they mention 1%, it comes with a premium. It is like an insurance which you are getting. So normally when you do a benchmarking exercise, you will end up with a lesser, in our experience, with a lesser rate of corporate guarantee. These are the judgments. Bharti Airtel being a little bit of a landmark judgment, where after where in the ruling, even though the assessee themselves had offered a corporate guarantee, the ruling came up that corporate guarantee itself is not an international transaction. Nonetheless, I think in the second column, Everest Kanto, all of these judgments, they treat corporate guarantee as an international transaction. In fact, the rate of interest guarantee in corporate, in case of Everest Kanto, which is 0.5%, has become like a benchmark rate across industries, and everybody is using that in all rulings rampantly, even the TPOs when we go for tax events. And then there are these three judgments at the end of the slide, which say that since no cost is incurred by India, there is no liability. Therefore, one need not really look at corporate guarantee as an international transaction. However, our view is to go with the corporate guarantee as an international transaction and do a benchmarking analysis to determine whether what is the value or the intrinsic value of this corporate guarantee. I think with this, we move to the issue of shares. Simply put, this was a very big issue which was blown out of proportion. A lot of foreign entities were infusing money in India, and then what should be the valuation? There was always a difference in valuation. The assessee came with valuation of X. The tax authorities came with a valuation of multiples of X. And what they said is that the multiples of X is something which is not come to India and should be imposed as a income in India. Simply put, this is a landmark judgment of Vodafone, where the Bombay High Court mentioned in the writ that there is no income arising from this international transaction, and therefore, any kind of ad hoc income should not be attributed. Even the CBDT by instruction number 2 of 15 has accepted the Bombay High Court decision, and what we have seen is this issue has been put to rest right now. There are no specific rulings coming out of this. There is no adjustment being made at the ground level right now. Nonetheless, I still feel that the best practices in this regard: get a proper valuation report at the time of issue of shares, whether inbound, outbound, use a registered valuer. In case of assumptions assumptions in this valuation report are challenged subsequently, document the key reason for variation. I think that is very important. And issue of shares, you need to still disclose it as an international transaction in clause 16, because whether or not you like it, clause 16 requires you to disclose it. The arm's length value of this transaction can still be determined in your transfer pricing study report, and you can give reference to instruction number 2 of 2015. With this, I think what I have done is this is an industry specific issue for ITS clients which we have taken. This is the common issues and approach. Normally, we have seen that the industry is broken into two parts. One is inbound and outbound. In inbound, there are two models which are followed. One is hourly rate and cost plus model. Outbound entrepreneurial companies. So when I say outbound entrepreneurial companies, are companies like the Infosys of the world, the Wipros of the world. cost plus companies are working on a cost plus basis. Hourly rate companies are working on charging for services on an hourly rate. Now the question is, the concept is what we have mentioned there. So in case of the hourly rate companies, these entities get characterized as normal risk-bearing entities. What happens is these entities could end up making losses, or they could end up making super profits. They will, because of the inherent nature. So example, in case of hourly rate companies, because the rate is determined based on market value, in that case, you can end up making either profit or losses depending on how you are able to manage your bench costs. However, if the hourly rate is determined based on an underlying principle of cost plus, then I think the rate, more or less, the profitability will be more in line with the industry standards. Second is usually, usually we have seen in case of hourly rate, if you use TNMM as the most appropriate method, it will be a big gamble for them, because what happens is you need to benchmark the hourly rate and not the profitability. Your profitability can vary significantly for such companies. What happens is, unfortunately, the data for hourly rates is not very easily available, and therefore, these issues remain for these companies which are inbound companies working on hourly rate. Most rampant, most common is use of cost plus method. Most of the Cognizants of the world, or let's say the Googles of the world, they have these centers which are working on a cost plus basis. What is important is you need to have a proper intercompany agreement in place, which will document what is the functions being performed, what is the cost plus model, whether you are providing high-end services, low-end services. What most of these companies miss out is free of cost services received forming part, whether it is forming part of the cost base. So what happens is cost base normally is determined based on financials, but a lot of times, the foreign companies are not really charging. The foreign companies are not charging for the ESOP costs which are issued to the Indian employees. So in my view, these costs also need to be factored in while calculating the cost base. So license cost, example, free of cost licenses that would be provided. Ambiguity with respect to what constitutes as pure reimbursement and what constitutes as pass-through cost vis-a-vis what constitutes as service. So whether a travel expense incurred for an employee who is going abroad to provide services is a reimbursement or it's part of a service. This becomes an ambiguity in such entities. And what happens is, because all or most of the cost plus entities, even though they may be appearing in the Proves database, all of them are going to be rejected because all these companies are providing services to their group companies. So getting perfect comparable becomes a bit difficult. And here is where, what Meenal was mentioning about risk adjustment or working capital adjustment, or some of these adjustments become more important. Entrepreneurial companies selecting India or the Indian entity as a tested party itself is a bit of a incorrect preposition. The foreign entities normally you would have to select as the tested party in these situations. The question also arises in these situations, in these companies, is whether brand royalty should be charged. The answer to most of these questions lie in a detailed FAR. And the points to consider, if you look at it, I think, in all the three baskets which we have mentioned, I think FAR is the most important aspect, because the FAR will determine whether, whether I'm working, my hourly rate is determined based on an underlying cost plus basis or it is market linked. If it is market linked, I will have I will use the other method or the cup method. When it comes to costless method, the FAR will determine which should be the correct comparables, which I should, what should be the economic adjustment. And again, the FAR will determine the tested party for me when it comes to entrepreneurial entities. So with this, I think we have covered, the issues which are there in the existing transfer pricing, the key issues which we wanted to highlight from the existing transfer pricing law. But what lies in future, and the drastic changes which have happened in the last 20 years or 21 odd years, and a lot of things are changing dramatically. I think from a brick and mortar still remains the main form of doing business, but not with the digitization and specifically the impetus that digitization has received because of the COVID. It becomes more and more complex. One of the issues which Meenal discussed while her taking a slide on multiple year data is that whether you should use multiple year data while doing an analysis for COVID year. COVID year is a unique year. Some companies have actually flourished, but a majority of them have taken a big hit. But then if I consider multiple year data, it becomes a big challenge. So some of these issues are new issues and which we will face as we go forward. The COVID years are this 2020, 2021, which are yet to be tested from a transfer pricing perspective. Now, what has happened is, I'll go back to my story, and here is where we have found a new friend, and that friend is in the form of BEPS regulation. And if you look at it, there are these wordings which I've highlighted on your slide: tackling tax avoidance and improving the coherence of international tax issues. If you look at my first slide, and I mentioned there, the reason why transfer pricing provisions were introduced is that we had manipulation of prices, tax avoidance, fair share in the global economy. And now what has happened is in 2016 or 2007, let's say 15, 16, our transfer pricing has, the child which has become a toddler and now it has become into its teeth, he has got a good friend in the form of BEPS. And this BEPS is having the same objective, and that's why they've been jailed together. So in my view, transfer pricing, the way forward, the future of transfer pricing is going to be a lot dependent on this BEPS regulation. Action plan 8 to 10, 13 and 14 deal with transfer prices. Quickly, BEPS itself is a big issue, and if I'll not go through it in detail, but quickly what action plan 8 deals with is with respect to TP aspects, with respect to intangibles. Action plan 9. So anything to do with AMP, royalty, all of them get discussed in action plan 8. Action plan 9 is with respect to the TP risks arising from contractual obligations. Action plan 10 talks about high risk transactions, and action plan 13 and 14 again deal with the transfer pricing. 13 deals with the transfer pricing documentation and how to bring all the global world into one stage where the transfer pricing documentation across the world is going to remain the same. It's something which is trying to be emphasized in action plan 13 as well as action plan 14, which deals with dispute resolution. This new friend has already had an impact, and as you grow your teen and you're reaching your adulthood, it has rubbed its shoulder on our adult transfer pricing law. Section 286 has been introduced. What it says is that the three parts which have come into the law are CBCR reporting, master file and local file. CBCR is country by country, where more like very, very big companies which have got global turnover, consolidated global turnover of euro 750 million or more, that is 6,500 crores roughly. They need to do certain reporting of certain criteria as mentioned. These come out of the BEPS regulations itself, and every country has again added or subtracted their own points in this regard. So section 286 was added to the Indian law, and certain compliances in this regard. So some of our big companies like Infosys of the world, etc., they have to do these compliances from an Indian perspective. Also, these companies of foreign entities in India, they may have to file certain notification, which will come to a little bit on the next slide. Master file is something which falls between CBCR and local file. Mid-sized companies, that is forming companies of the group of around 500 crore turnover globally, they need to do certain additional reporting. What happens is, BEPS has come up with this recommendation that you need to have more data sharing in order to come at a transfer pricing. So the data sharing forms the crux of transfer pricing analysis. And with master file, they have identified certain criteria which, if shared at a centralized location, then the company, that is the governments, through exchange of information or otherwise, they can get this data from the other entities. So master file provision was also introduced in the Finance Act of 2016. Local file, I think they have, again, BEPS came up with its own regulation, but the Indian transfer pricing law was very robust, and our section 92D already dealt with whatever information is required for the purpose of local file. So local file is very akin to the transfer pricing study reports that we, the taxpayers in India, are maintaining. Again, these are the forms which every entity needs to file. I'll not go through these forms in detail. One just point from our side is that master file is also to be filed, at least the part A, by all the entities doing Form 3CB in India, most likely than not. That is the point which I wanted to just leave the audience with. Also, the question is, all these compliances which have come from 2016-17 onwards, how the filing of CBCR or master file is going to impact the taxpayer is something which we'll have to see, because right now none of them have been used for the purpose of transfer pricing assessment. But let's see how they will be used going forward. With that, last couple of slides which I would like to take you through. What are the TP issues which will come in future? Point is that, as we have a growing startup culture and a lot of emphasis on homegrown technology, as a result of is resulting in a flurry of intangibles. So a lot of India-bound Indian companies who are startup companies, they're having their own technology which is coming up. So the question with respect to development of intangibles, ownership of intangibles, and the question of DEMPE, which is already defined in the acronyms, you can look at it, and comes out of the BEPS principle, becomes very important. So I think intangibles is going to be one of the key issues which will be looked at by the tax authorities, as well as the will be a matter of detailed discussion between tax authorities and the taxpayers. Second and the third basket is cost contribution arrangement intra-group services. As world is becoming one market because of the IT infrastructure, more and more transactions are becoming intertwined. What is going to happen is that there are going to be more such situations where either a cost contribution arrangement and an intra-group service are going to be provided by the group. What is important is what all documentation is maintained and how you are able to demonstrate that documentation, whether it is cost contribution or whether it is intra-group services. Financial transaction, well, that will always remain, because as money is flowing into India and more money, Indian entrepreneurs are also going abroad, there are going to be more and more such financial transactions and different type of transactions which will be kept on incurring, whether it is in loans or whether it is corporate guarantee, etc. Hybrid debt instruments. So all of these keep on growing. As they keep on growing, financial transactions will be a matter of transfer pricing analysis. Two new issues which they had their own time in between, but they have not yet come up. One is on location saving. What does location savings mean? Developing countries would have an inherent advantage by way of lower costs vis-a-vis developed countries. So the developing countries like India, we call up, we have a lot of inherent cost advantage when it comes to labor, etc. So whether because of this advantage we should we should get some kind of a premium while pricing the transaction. That is going to be a matter of discussion going forward. In common parlance, it is known as location savings, and then there is something known as demographic advantages. Countries with higher population, that is, like India, China, they boast their potential, the consumption power which they have. What such countries may want to get a fair share or higher share in the global pricing value chain when it comes to allocating weights during valuation of any transaction. So example, let's say tomorrow again, if WhatsApp or somebody were to be sold, in India we have got more than 600 million users or 700 million users, and whether a fair share of that should also come of the valuation or some profitability arriving out of that should come to India is a matter of transfer pricing discussion going forward. In our view, two things are important. One is that there is a need for guidance on these things. Something to look forward is Australia has always been giving their transfer pricing guidance, and they come up proactively with their own laws in this regard. So they come up with their guidance, and which helps the assessees proactively look at their transaction and disputes are avoided. So something can come from the Indian tax authorities, it is more welcome. It could be a learnings from the APA, etc. But until such time comes, the underlying principle remains FAR, that you do a detailed FAR analysis for all your transactions, and basis that you will get answers for most of your transfer pricing disputes. The future of TP litigation, a risk-based approach is to identify international transaction. Already we are on that way. So instruction number 3 of 2016 already is traveling that path. Right now, most of the companies can get selected for transfer pricing scrutiny only on the basis of a CAS observation. Similarly, going forward, EE proceedings are going to be applicable for TP proceedings post 31st of March 2024. TP being very specific, a bit complex also, and you have to explain the business. Something of that sort explaining e-proceeding becomes a bit of a tough challenge. So there should be some option provided to taxpayers if they want to really have a one-on-one hearing, or at least some sort of online hearing should become, in my view, is something which one can expect. Also, transfer pricing does not change rapidly over the years. Most companies follow the same methodology or the same business over the years. So a block assessment is something which also can be looked at from a transfer pricing law perspective. And this is in line with global practices. Some of these developed economies, they take a block assessment, 4 years, 3 years together, and then they do the transfer pricing together. It will also give the tax authorities a lot of time, and also time as well as understand the business appropriately and then give proper judgment on the transaction. Last impetus on speeding up the alternate dispute resolution mechanisms like APA, MAP, also the safe harbor rules which are there right now in the current stage. They can cover more transaction and maybe come up with more reasonable margins, so that a lot of companies just go for it. Safe harbor rules are more like an insurance. If they come up with a better or a little bit more reasonable, I think a lot of companies will want to go ahead with the safe harbor rules rather than waiting for an APA or a MAP to happen. These are some statistics on your page with respect to the APA. Why I was saying that we need to speed up. What is on the screen is only the number of APAs signed, but there is a host number of APAs which have been filed which have not yet come, and the number is in multiples of this. So I would believe that the government is trying. I'm sure in the last couple of years, because of the COVID and all these reasons, they were not able to really focus on this, but that can be a good way forward when it comes to pushing, getting more clarity on transfer pricing matters. Yeah, this is the last slide, and the way I said that the journey of the transfer pricing, the journey so far. Now I'll say the SAR, and this SAR, when I'm saying it, I've written it in Hindi. The SAR, whoever understands that, of TP analysis lies in a good FAR. So whether it is got identification of tested party, whether it is got to do with most appropriate method, selection of the most appropriate method, whether it is to selection of PLR, whether it is to do with which filters to apply, which methods to select, whether a transaction becomes an international transaction, what characterization, what are the terms of the condition, all these things, whatever I have been discussing, me and Meenal have been discussing during this entire presentation, it goes back to the FAR analysis. And therefore, as I said, the journey so far, because it is going to continue, as we go ahead, even the issues with respect to future, which I talked about, with the intangibles, about cost contribution, if you have a superb FAR, you're going to be more likely than not to defend your particular transaction. And most of the judgments right now which are coming from ITAT, every day there are 5 or 6 judgments on TP. Most of them go back to the facts which is on the FAR analysis. So if you have a detailed FAR analysis, I think our transfer pricing, which is now adult, he's now able to understand what he wants. He knows what he wants, and therefore I feel that after 21 years now that he is adult, he knows that you have to do a proper FAR analysis, and therefore I would like to leave the discussion with that the journey of transfer pricing lies in our proper FAR analysis. Yeah, I think this is my team who has helped me, Mahesh, Rahul, and Shantanu, who has helped me take this, build this entire presentation. Of course, both of us, this email IDs are there on the slide. You can ask us any questions and we'll be happy to take it. Right now, what I will do is, considering that we have some time left, I'll be happy to take some questions.
Yes, sir. We have 2-3 questions that came up. I'll share my screen, sir. Thank you. Thank you so much for your excellent time, sir. Presentation. Is my screen visible? We have 3 questions that is lined up. 1 minute, sir. It's getting loaded. Yeah.
Okay, so yeah, I think your screen is very visible now. So the first question is whether individual person considered as associated enterprise. The answer lies yes. Individual can also become associated enterprise. In fact, when you go through your related party transaction, what I also recommend most of our clients is that there are going to be non-resident directors who are also shareholders to whom certain payments are made from India. A lot of times you miss reporting this transaction. So individuals who satisfy the condition of section 92 A1 and more like the way we discussed 92A2, they would qualify as associated enterprises as long as they fall into the definition there. I think the next question is one company which is manufacturing food products giving marketing to other company. Directors are same in both the companies. Will these transactions arise TP? I'll just summarize the question again. Maybe what I understand is there is one company which is manufacturing food products and giving marketing services to the other company as well. The directors of both the companies are same. The point is that if just having same directors may or may not really become may not hint at transfer pricing. The way the section reads is that the same person has appointed more than 50% of the directors in same company. So if the same person has appointed the directors in both the companies, or more than 50% of the directors are same, then transfer pricing, they become associated enterprise. So the question is, just having common directors is not important. One, you have to look at the appointment process for these directors, and then if they're appointed by the same people, then the TP provisions, they would become associated enterprise, and consequently TP provisions will become applicable to such companies. The third question is how to make out whether capacity utilization adjustment or working capital adjustment, which of the two is applicable to the to a given case. Okay, so what I will do is quickly I will reiterate the concept of capacity utilization and working capital. They come in two different situations. Working capital adjustment comes when there are differences in working capital cycle. I'll give you a very simple example so that we can all relate to it. There is one company which is X. So let's say I'll take my name and start with it. I am the Indian company here, and Meenal is the foreign company, my associated enterprise sitting somewhere in Europe. I am selling the goods to her at 100 rupees, or let's say $100, and she says that I will give you the money after 2 months. The same good I am selling to a third party, let's say in USA for the moment, and he says that I will give you the payment after 6 months. So what will happen is the underlying assumption in transfer pricing is that when I'm selling my goods to Meenal, who is my associated enterprise, at $100 with 2 months credit period, when I'm selling it the same goods to the third party with 6 months credit period, the answer is going to be that I'll not sell it at 100 rupees, but I will say I'll also impute the interest cost for that additional 4 months. Could be example in our case 4 rupees, and I will do 104 rupees sale. So that there is a difference in profitability now, because what happens is when I'm selling the goods to Meenal, it is at $100. When I'm selling it to third party, I am going to sell it at $104. What happens is because of these differences in pricing at the EBIT level, that is earnings before interest and tax, the profitability of third party will appear to be on the higher side, because the interest cost is not. So the concept goes back to PLI, and the PLI, normally when you talk about operating profit, you talk about EBIT, that is earnings before interest and tax. But in case of a third party, that 4 rupees of interest cost is going to sit below this EBIT. So in this situation, you look at the EBIT, you look at earnings before tax, and in that case, the profitability for Meenal, that is selling the AE as well as to third party, is going to remain the same. So this concept of differential pricing, because of the differential credit period offered, and here I've just taken a simple example of credit period. It can go down to inventory cost, it can go down to even creditors, etc. So what all factors can impact working capital are multiple, though. I've explained it in by way of credit period right now, are different, and therefore when there is a difference in credit period or working capital cycle, you do a working capital adjustment. But when do you do a capacity utilization adjustment? When there is a difference in utilization of capacity. What does it mean? The way Meenal explained is a lot of the startup companies, like giving you example, let's say Volkswagen, they will, or even let's say right now, all these new companies which are Kia or some of these new entrants of MG Motors in Indian market, they will not set up a company, the manufacturing plant, let's say for only 1,000 units or 10,000 units. They will start directly set up. Like Kia, when they came to India, they set up with a 3 lakh unit. Similarly was the case with Volkswagen when they had come way back in India. But what happens is in the initial years, they will not have that kind of capacity or that kind of sales. So they will have much lesser sales as compared to the comparables. So initially, let's say I'll just take a simple example. Kia Motors would have just sold possibly 1 lakh units in the first year. Vis-a-vis their capacity was 3 lakhs. So they are operating at roughly 33% capacity in India. Now you compare this with Tata Motors, Maruti, Hyundai, all of them are already operating at 60-70% capacity. So what is going to happen is because of the differential capacity utilization which is there, Hyundai, Maruti, Tata Motors, they are able to absorb the fixed cost better. Vis-a-vis Kia Motors possibly is not going to be able to absorb the fixed cost better, and therefore you need to do a capacity utilization. And so that you are able to neutralize the impact of the transfer prices, sorry, the profitability between two, and then you make them like-to-like comparables. So this comes out of capacity utilization. So working capital adjustment deals with the credit cycles, inventory cycles. Vis-a-vis capacity utilization deals with the fixed costs. It could be either assets or it could be even employee costs or any other costs which are being fixed in nature. That is the difference between working capital adjustment and capacity utilization adjustment. Both seek to neutralize different things. One, working capital wants to neutralize the working capital cycle. Capacity utilization wants to neutralize the underutilization of capacities. That is the difference between the two. I think the next question is, if the foreign incorporated holding company has remitted money to Indian subsidiary as advance against future services, how to apply TP margin if foreign company is a new entrant to Indian markets, so we have no data to compare. Let me just quickly look at this question. If the foreign incorporated holding company has remitted money to Indian subsidiary as advance against future services, the answer is that if you have received money as advance towards future services, you need to right now report it in your form 3CB as advance, because there is no service which has been provided to it. Now the question is, from an Indian transfer pricing perspective, because this advance has come, and if it has come free of cost, there is no interest imputed on that. You need to only disclose it in the form 3CB and of course in your transfer pricing documentation. There is no transfer pricing analysis which one may have to do on the same. The second part of your question is how to apply TP margins if foreign company is a new entrant. So whenever you are going to provide service, remember at that time the money will be adjusted from these advances. At that time, maybe it will be good if you do a working capital adjustment vis-a-vis comparables, because in most of the cases the comparables would be having a working capital cycle which is not advance based, but it is going to be credit based. So that time you may have to do a working capital adjustment vis-a-vis comparable. But purely advance should be reported as an international transaction. Where to report, whether it should be in clause 14, 16 or in clause 19, doesn't really matter as long as you report it depending on the underlying reason why you have received it. In my view, you should report it in clause 19. No need to do a transfer pricing analysis because it is an advance. There is no section 92, and if it's an interest-free advance, there is no question. But if there is interest being imputed on the advance, it becomes like a loan transaction, and then you have to look at the transaction as if it's a loan received and then do specific benchmarking using the base. That is, if it is LIBOR based or if it is a Indian rupee based loan, depending rupee based advance. A proprietorship concern provides services to a foreign company. The proprietor of the concern and the director of the company are relatives. A proprietor concern provides services to a foreign company. The proprietor of the concern and the director of the company are relatives. Are the transaction between the concern and the company reportable as 3CEB? Interest. So what? When you say relative, I would need a little bit of more details here in my view, so that I am able to understand that. But in my view, when you talk about relative, if they are brothers, if they are going to be immediate relative in that sense, or the meaning of relative as defined in Income Tax Act, in my view, they would qualify for the purpose of transfer pricing as being relative, as being associated enterprise, and to that extent, TP provisions will be applicable.
Yes, sir. Those were the questions, sir, and thank you so much for your time spent here, sir. And if there is any question that came up over mail, we'll send it to you. So when time permits, you can respond, sir. And since you have shared your mail ID in the presentation, there may be a question that's flowing into your mails also. And
Definitely.
our regional council member is engaged with another meeting, so she couldn't join at final vote of thanks. And thank you so much, ma'am, Meenal ma'am, and Tejas sir, for your excellent presentation on transfer pricing in the journey so far. And on behalf of SIRC chairman, secretary, and office bearers in the absence, we thank you so much for your time spent here on knowledge estimation. We look forward to have you in future for another more sessions. Thank you so much.
Thank you.
Thank you.